So today we're talking about the Nova Scotia 2% down payment program for first-time home buyers. And we're actually going to dissect this program into detail for people to understand more of what it is, who will it benefit, and for you to understand, is this the right product for you? We talked about earlier in our previous discussion with insurance premium versus no insurance premium. For those who don't know what we're talking about, for just a regular viewer, what I want to say is when you're buying a house in Canada, you fall under the federal guidelines of what are you purchasing it with. Are you buying it under 20% down payment or with more than 20% down payment? So in Canada, the rules are if you're purchasing a home with less than 20% down payment, you automatically pay into a mortgage insurance premium. That mortgage insurance does not cover you. It covers the lender if you default on the house. So if you go into bankruptcy, the lender is covered. That way they can offer you really good rates and you're lower risk to them. That is why that program exists. There's 3 mortgage insurers in Canada, and there is a scale of what the insurance premium is based on your down payment. So today we're talking about minimum down payment because we're talking about the Nova Scotia minimum down payment program. If you were to buy through the federal program with the 5% down payment, you're actually paying 4% on a mortgage insurance premium, which is added at the beginning of your mortgage. So if you do 5% down payment on a purchase price of $500,000 and the mortgage insurance premium is 4% and it's added back to your mortgage at the beginning of the term, you've only actually done 1% down payment on the purchase of your home as when you're buying it. Now with Nova Scotia, how they're able to bypass that is this is a provincial program and they can only go through the credit unions because the credit unions are only provincially regulated. Credit unions are not federally regulated entities, so you don't have to follow the federal regulations of the 5% down payment, and you don't have to go into the mortgage insurance premium because now Nova Scotia is acting as the insurer for those credit unions. So what does that mean for you as a buyer? With the 2% down payment, there's no insurance premium. The province covers that on your behalf. Now, this has limitations for what you can do if you are going under this program. So if you are buying with a 2% down payment, again, let's use the numbers of 500,000 as the purchase price, and you do the 2% down payment, the province of Nova Scotia is actually acting as a guarantor for that insurance for the credit union. So if you default and you go into bankruptcy and you have to get rid of your house, the credit union is not out all of that money that you put down, that you owe on the mortgage. The province will come in and cover that for you. Now, the limitations on that, apart from just the basic application, is renewing and refinancing. That is the biggest thing I haven't seen anybody talking about yet. So you have to, if you're going under this program, again, 2% down payment is very little. So if you want to go to another bank in 5 years, or if you want to renew with another monoline mortgage lender, you have to own and pay off at least 20% of the equity in your home before you can go outside of the credit union. So that means that if the credit unions in 5 years' time decide to raise their rates by 1% more than the regular banks, you have to be able to pay off 20% of your home equity to go somewhere else. Now, the rules on this are not defined. And again, because this program is new, I had questions that no one's been able to answer yet. And once I figure it out, I will post about this. So my first question was, okay, is this asking about 20% of equity that I own in the house? Because the housing market here is growing. So I could potentially have 20% of equity in 5 years at renewal if the housing market continues to go up. Or is it talking about specifically me paying off 20% of equity? Because that's a huge difference, right? Most people don't pay off 20% of equity in their first 5 years of their mortgage life. And the reason being is that when you get a mortgage or you get any kind of loan in Canada, the first 10 years of that loan's life, you're paying 2/3 of that onto the interest and about 1/3 of that on the principal. These aren't exact numbers, but this is for reference, that the majority of the money actually goes on interest and the small portion goes on the principal balance. So over the first decade, you're really paying out that interest. And then over the last decade of your mortgage, you're slowly paying down the principal. So in this case, nobody's been able to answer me yet on how that actually works. And then the other thing is, if I'm selling my house, is there any implication or any penalties? I haven't heard on that either. So we're still looking into that, and we hope to hear from either the province or from the credit unions themselves on how that is applicable. And the other thing is refinancing. So most people who own their house, at least 2 in 5 people that I have as my clients, will refinance their mortgage within 5 years. They refinance because they need to get low interest rates, and they need that money to either pay out their debt at high interest rates like car loans, lines of credit, credit cards. They need that money to reinvest into something else. Real estate investors use their homes, take out equity to buy another property. If you're talking about refinancing for like a spousal buyout, things like that, most of the time there's set rules for that, but this has not been refined yet. There's still no, it literally just says that you can't refinance your house unless you own 20% of equity, which is true for pretty much every lender. You have to own 20% of equity in your home, but here it doesn't specify if I have to pay that 20% off out of my own pocket, or if it just has to be 20% of equity because the market has naturally grown in Nova Scotia. So that has not been refined, and I haven't had answers on that yet. I'm curious to see what that is going to look like in the near future. And the other thing you were talking about is insurance premium versus not insurance premium. So if I was to buy a house today with a 2% down payment, no insurance premium, and if I was to buy the house at 5% today with insurance premium, and I was to sell both houses, I would walk away with, not wasting any money from the 2% versus actually losing money on the 5% because I only actually put down 1%. So there is that difference, right? You do have quite a bit of a difference. Now with amortization, which is another one, the federal government recently rolled out last year the program for first-time home buyers being able to do 30% down payment, which puts them in a higher bracket of what they can afford, because that 5 years of amortization lowers their monthly mortgage payments significantly. And this program only allows up to 25 years because you can't combine programs. You can't have the federal program and the provincial programs mixed. This also means that you can't do purchase plus improvements or other federal programs through the insurance premiums that are available with this program. So you can't mix and match stuff. You can't combine different things. So this is where it plays a role of importance to talk to a mortgage broker or the credit union or a specialist who can answer these questions, because I had to research all this information and every credit union had different information on it. The provincial government rolled out their program of what is eligible for this 2%, but they're also allowing the credit unions to add their own rules. So that's very crucial that you talk to a broker and they can help you find the best option for you for that.